Video 8 was the covered call. Video 9 was the cash-secured put. Both strategies generate income by selling options premium. Both use the same 30 to 45-day expiry window. Both let theta work in your favor. What you are about to see is what happens when you combine them, not as two separate trades, but as one continuous system running on the same stock, month after month, cycle after cycle. The wheel is not a new strategy. It is the covered call and the cash-secured put operating in sequence, linked by the moment of assignment. Sell the put, get assigned, sell the call, get assigned, sell the put again. The capital stays deployed, the income keeps arriving, and the stock you chose does the work of generating the premium. This video shows the full cycle, every phase, every transition, and exactly how the numbers accumulate. This is what systematic income generation looks like in practice. The wheel has 3 phases, and they cycle in order. Phase 1. You sell a cash-secured put on a stock you want to own. You collect premium. If the stock stays above your strike, the put expires worthless, and you repeat Phase 1. If the stock falls below your strike, you are assigned. You buy 100 shares at the strike price. That assignment triggers Phase 2. Phase 2. You now own 100 shares. You immediately sell a covered call against those shares. You collect premium again. If the stock stays below your call strike, the call expires worthless, and you repeat Phase 2. If the stock rises above your call strike, your shares are called away. You sell them at the strike. That triggers Phase 3. Phase 3. Your shares are gone. Your capital is back as cash. You return to Phase 1 and sell the put again. The cycle is complete. The wheel keeps turning as long as you have the capital and the conviction. Phase 1 in detail. You have cash, $17,750 set aside. Apple is trading at $182.50. You sell the $177.50 put, 35 days to expiry, at $2 even, collecting $200 immediately. 2 things can happen. Outcome A. Apple stays above $177.50. The put expires worthless. You keep $200. The $17,750 is released. You sell the next put. 1 month of income without acquiring any shares. Outcome B. Apple falls to $177.50 or below. You are assigned 100 shares at $177.50. Effective cost basis, $175.50 after the $2 premium. You move to Phase 2. Either outcome is acceptable because you chose the strike at a price you were willing to pay. The put premium is income in outcome A and a cost reduction in outcome B. Phase 2 in detail. You now own 100 shares of Apple with a cost basis of $175.50. Apple is trading at $176, just below your assignment strike of $177.50. Immediately, you sell the $182.50 covered call, 35 days to expiry. The premium, $3.20, $320 collected. 2 things can happen. Outcome A. Apple stays below $182.50. The call expires worthless. You keep $320. You sell the next month's call. You are still in Phase 2, generating income from your shares. Outcome B. Apple rises above $182.50. Your shares are called away at $182.50. You receive $18,250 for the shares. You move to Phase 3. Again, both outcomes are acceptable. Either you collect more premium or your shares are sold at a price above your cost basis. Phase 3. The full cycle completes. Your shares were called away at $182.50. Here is the accounting for the complete cycle. Phase 1. Put sold at $177.50, premium collected, $200. Assignment cost, $17,750. Effective entry, $175.50. Phase 2. Call sold at $182.50, premium collected, $320. Shares called away at $182.50. Share proceeds, $18,250. Total result, premium from put, $200. Premium from call, $320. Share appreciation from $177.50 to $182.50, $5 per share, $500. Combined income, $1,020. Capital deployed throughout, approximately $17,750. Return on capital, 5.7% in approximately 70 days, 2 35-day cycles. Annualized at that rate, approximately 30%. The wheel returned to Phase 1. You sell the put again. What makes the wheel work is capital efficiency. Your $17,750 is always deployed. In Phase 1, it sits as cash collateral earning put premium. In Phase 2, it is fully invested in shares earning call premium and potential stock appreciation. There is no idle capital. Every 30 to 45 days, one of two things happens. You collect premium and reset, or an assignment occurs and you transition to the next phase. The transitions are not disruptions. They are designed outcomes. You plan for them. The key metric to track is not individual trade performance, but cycle return, the total income generated per full rotation of the wheel. In the example above, $1,020 on $17,750 over 70 days. Even in a flat or mildly declining market, premium collection alone generates consistent returns. The stock does not need to go up for the wheel to generate income. Stock selection is the most important decision in the wheel, more important than strike selection or expiry selection. The stock you choose becomes your long-term partner in this strategy. If the stock collapses 50%, no amount of premium collection will offset that loss in a reasonable time frame. The criteria for a goodwill stock. 1. You genuinely want to own it long-term, at the strike price, through drawdowns, for months or years. 2. It has liquid options, tight bid-ask spreads, high volume, high open interest. 3. Implied volatility is moderate to elevated, enough premium to make the strategy worthwhile without being a speculative miner or biotech with binary event risk. 4. The stock has a history of recovering from pullbacks, not a company in structural decline. 5. It is not facing a near-term binary catalyst, earnings, FDA approval, legal ruling, that could cause a gap beyond your strike in either direction. Apple, Microsoft, Nvidia, SPY, QQQ. Well-capitalized, liquid, recoverable. These are well candidates. Single-name speculative stocks are not. The income math across multiple cycles. Assume you run the wheel on Apple indefinitely, completing one full cycle every 60 to 70 days. At a conservative return of 4% per cycle, some cycles only generate put premium, some generate both put and call premium plus stock appreciation. You complete approximately 5 cycles per year. For percent times 5 equals 20% annual return on the capital deployed. At 5.7% per cycle, the number is closer to 28%. These are not guaranteed returns. They assume the stock cooperates and does not have a sustained decline. In a flat or range-bound market, exactly the environment where most investors earn nothing, the wheel generates consistent income. The strategy is not trying to predict direction. It is extracting premium from the uncertainty that exists in every market condition. That is the structural edge. You earn from time passing, not from being right about direction. The risks of the wheel, stated clearly. Risk 1. The stock falls significantly below your put strike and keeps falling. You are assigned shares at $177.50. Apple drops to $150. You now own shares at an effective basis of $175.50 with the stock at $150. Paper loss of $25.50 per share, $2,550. The covered call premium you collect going forward is small relative to this loss, and you need the stock to recover before the position becomes profitable again. Risk 2. The stock gaps through your call strike, missing a large upside move. Apple announces a breakthrough product and gaps to $220. Your shares are called away at $182.50. You miss the move above that strike. Risk 3. Implied volatility collapses. Premium on both the put and call shrinks significantly. The income per cycle decreases. The strategy still works, but generates less per cycle. Risk 4. Liquidity risk on the underlying. If the stock becomes hard to trade in options, spreads widen and the strategy's efficiency drops. Managing a losing wheel position. Apple has fallen to $160. You own shares at a $175.50 effective basis. The covered calls you are selling are generating small premiums because the strike has to be significantly above the current price to avoid immediate assignment. What are your options? Option 1. Continue selling calls patiently at $165 or $170 strikes, collecting modest premiums, waiting for a recovery. Each monthly cycle reduces your effective cost basis a little further. Option 2. Roll the put down, not applicable here since you are already assigned. Option 3. Accept that the position is underwater, sell the shares, crystallize the loss, and take the capital to a different stock or a different strategy. This is the hardest decision, but leaving capital trapped in a deteriorating position has a real opportunity cost. Option 4. Sell a lower call strike to generate more premium, accepting a below-cost basis exit if assigned, limiting the loss. The wheel does not guarantee profit. Stock selection prevents you from needing these decisions most of the time. When the wheel works best, and when to avoid it. It works best when the stock is range-bound or mildly trending. Flat markets are the wheel's natural habitat. Implied volatility is moderate to high, more premium per cycle. You have a long time horizon. You can hold through drawdowns without panic. The stock is a quality company you are genuinely happy to own. It does not work well when the stock is in a strong sustained uptrend. You keep getting assigned on the call side and missing the full upside. A short call strategy in a bull market caps your gains significantly. The stock is in free fall. Premium collection cannot keep pace with share losses. For is very low, premium is too thin to justify the capital commitment. You have a short time horizon. The wheel needs time to generate returns across multiple cycles. Compare the wheel to simply buying and holding. In a strong bull market, buy and hold wins. In a flat or moderately volatile market, which describes most market conditions most of the time, the wheel generates superior returns with the same stock exposure. Practical execution checklist for running the wheel. Before entering, confirm the stock passes all 5 selection criteria: conviction, liquidity, for level, recovery history, no binary events. Choose your put strike, slightly out of the money, 65 to 75% probability of expiring worthless. Select 30 to 45 days to expiry. Confirm the options are liquid, spread under 50 cents, volume above 200, open interest above 500. At assignment, put, immediately sell the covered call. Do not wait. The call should be the first trade you place after assignment fills. Strike, slightly out of the money above your put assignment price. At assignment, call, confirm total cycle profit, put premium plus call premium plus stock appreciation. Return to phase 1. Immediately sell the next put. The key discipline: every transition is planned, not reactive. You know what you will do in each scenario before any of them happen. Decision paralysis kills the wheel. Systematic execution runs it. The wheel versus selling puts or calls in isolation. Selling only cash-secured puts. You collect put premium, but if you are never assigned, you never access the covered call premium. You are leaving half the income engine idle. Selling only covered calls. You need to first buy the shares outright. Paying full market price for shares is less efficient than being assigned via a put at a discount. The wheel sequences both strategies to maximize the use of your capital at every stage. You are never sitting in cash without income, and you are never holding shares without selling calls. The wheel is the complete income system, not a combination of 2 separate strategies awkwardly joined, but a single integrated cycle where each phase flows naturally into the next. The assignment triggers the transition, and the transition is always planned. This is what separates systematic income generation from opportunistic trading. The system keeps running regardless of which way the stock moves. The complete wheel on one page. Stock: Apple at 182.50. Phase 1, put sold, 177.50 strike, 35 DTE, $2 premium, $200 collected. Assignment at 177.50. Effective basis 175.50. Phase 2, call sold, 182.50 strike, 35 DTE, $3.20 premium, $320 collected. Assignment at 182.50, shares called away. Full cycle result: put premium 200, call premium 320, stock appreciation 500. Total $1,020. Capital deployed $17,750. Cycle return 5.7%. Duration approximately 70 days. Annualized approximately 30%. Repeat. Return to phase 1, sell the next put. 5 criteria for stock selection: conviction, liquidity, moderate for, recovery history, no binary events. 1 system, 2 strategies, 1 continuous cycle. Here is what you now know and can now do. 1. The wheel combines the cash-secured put and the covered call into a continuous income cycle. Sell put, get assigned, sell call, get assigned, repeat. 2. Capital is always deployed. In Phase 1 as collateral earning put premium. In Phase 2 as shares earning call premium and potential appreciation. 3. Both transitions, put assignment and call assignment, are planned outcomes, not surprises. You decided in advance what to do in each case. 4. Stock selection is the most critical decision. Choose quality stocks you are genuinely willing to own through drawdowns for months or years. 5. The wheel works best in range-bound and mildly volatile markets. Its natural habitat where buy and hold earns nothing and the wheel earns consistently. 6. Track cycle returns, not individual trade P&L. $1,020 on $17,750 over 70 days is the unit of measurement. That is video 10 complete. The next video covers the protective put, the first defensive strategy in this series, and the one that lets you hold stocks through uncertainty without risking your full position.